Welcome back. Yeah, special edition of Newsfeed, the budget edition of Newsfeed here on Newzroom Africa, channel 405. Big announcements from the Finance Minister, Tito Mboweni. I'm afraid massive. Did I say massive? I meant massively staggering increases in some taxes. If you like your spirits, well, stock up now because it's going to cost you a fortune. We're going to obviously look at social grants. The increases there do seem to be below inflation, so they may well be a reduction in real terms. With me, Kopano Gumbi and Ayabonga Cawe. Kopano, good afternoon to you. I mean, we need to look at the SOEs. You've been crunching the numbers here, and I mean, the debts that our SOEs are absolutely staggering.
It is quite significant. I mean, we see here that the total debt of SOEs is around 692 billion rand. 100 billion is due to Eskom in the next 3 years, is due because of Eskom, I should say, in the next 3 years. That's going to be a significant drag on our fiscal framework.
And these are SOEs that can't really pay it back themselves. I mean, there doesn't seem any way out of it.
Unfortunately not. They keep rolling and rolling and rolling through their debt. And we see SAA in a similar position. Denel, unfortunately, in a similar position, the SABC, AXA, all of them getting special mention in the budget policy statement because they are in a serious crisis.
Ayabonga, I mean, the problem with SOEs is they're difficult to fix, right? They're supposed to perform a function. They've been difficult to fix for a decade. They just get more and more difficult.
I think the longer we let the problem fester for, the more difficult it becomes to resolve it, Stephen, because what ends up happening is that you create a path dependence. Where everybody who's onboarded and joins the organization joins in a certain type of environment which is probably inimical with our national interest. And I think, the priority, which is something I would have loved to hear a lot more about, is how do we deal with the debt challenges of some of the other SOEs that have started to join that queue, the Land Bank, the South African Broadcasting Corporation. We have some challenges at the Road Accident Fund. And you can imagine all of this happening in a context where certainly the pie isn't as big enough to go around to all of these SOEs.
So, I mean, the pie is not going to get any bigger. And, I mean, we need to talk a little bit about what all of this means in terms of how this ends. I mean, the Finance Minister suggesting that debt will sort of stabilize after 3 to 4 years. I mean, I want to believe him. I really do. But, I mean, it's a curious figure, 88.9%.
I think we were saying with Kopano to Tammy earlier that, the credibility of that aspiration or target is something that even the marketplace is going to place a lot of question marks around. I mean, the Finance Minister came this time last year and said they wanted to run a primary budget surplus through an aggressive debt reduction process. And a lot of sort of arena said to him, well, this is not something that you want to do at a time where you have such a massive demand and supply shock. And I think, the same critique can be applied now. We're not out of the woods. It's the virus that sets the timeline of our response. And I think even our vaccination program, even if we do roll it out, we might still find ourselves in a difficult moment. And I think for us to ambitiously say that by 2024, we're going to be running a primary budget surplus, I think is something that is not going to be seen as credible by the marketplace. I think the additional layer to that, Stephen, is the implications that these aggressive reductions are going to have on aggregate demand and by extension GDP growth. We often don't talk about the denominator. We like to talk about the stock of debt, which is the numerator, and debt service costs. But we seldom talk about, I guess, the relationship between the spending and the implications that has for the growth in national output or GDP. And I think that's what we should be targeting.
Right, I mean, plenty more to come on that. And of course, there are big conversations around how all of this is going to play out and what the actual change is going to be. Let's get some more reaction now. Razia Khan is the Managing Director, Chief Economist for Africa and Middle East Global Research at Standard Chartered Bank. Razia, good afternoon to you. Thank you for your time. Our Finance Minister predicts that our economy will grow by 3.3% this year. That's after a big contraction last year. Is that a solid prediction?
Yes, certainly. Our own forecast at Standard Chartered is not too out of line with that. And what we have to take into consideration is that last year there was such a sharp contraction that it doesn't take very much to turn growth positive again. The expectation is that a lot less of activity will be impacted despite what we've seen with the second wave of COVID. It doesn't compare with the hard lockdown that South Africa saw last year. So achieving positive growth in 2021 is not the issue. The real issue is what drives growth in the years beyond that.
I mean, maybe I missed it, but I didn't see a huge structural reform that is going to drive growth in the years beyond that.
So the market reaction to the budget was overwhelmingly positive, but this was really because of the reassurances on the funding strategy. For bond markets, what everyone was focused on was what would happen to local currency issuance plans. And the announcement by Treasury that they will be utilizing existing government cash balances even more significantly than previously thought to fund what government does essentially means that there will be less borrowing in local debt markets in the years ahead. And that is what everyone is focusing on. But you're absolutely right in terms of the bigger issues, the structural issues facing the South African economy. Yes, there were some measures that are a nod to growth. The anticipated future cut in corporate income taxes, for example, but everyone would still be looking for those drivers, that knowledge that accelerated growth in the future can be more secure. And for now, that just isn't known.
We need to talk a little bit more about our debt, of course. And I mean, Mboweni saying we'll stabilize government debt at 88.9% of GDP by 2025, 2026. Now, a lot of things need to happen. We need to have a vaccine. We need to have a growing economy. We need to make sure that there are no new variants that emerge of COVID-19. It's quite a big prediction to make, and yet a curiously precise one.
Well, the Treasury will have to come up with projections, both for the fiscal years ahead and also in terms of what this is likely to mean for the debt profile. The good news for markets is that as alarming as the numbers are, and we need to put this in context, lots of emerging markets the world over have seen more expansionary fiscal policy, debt ratios changing very dramatically. The good news for the markets is that these numbers are still better than what had previously been outlined by Treasury in the medium-term budget last year. Of course, you raise a very important point. There is so much uncertainty. The rollout of vaccines, the effectiveness of the vaccines against the new variants, how much economic activity is likely to bounce back in the future. Some of the threats that the South African economy has been facing for some time now to do with SOE finances. There is a great deal of uncertainty, but for the moment, we do believe that markets will be focusing on the good news, and at least in terms of the variables that are in control of the Treasury, the funding strategy, that does have an impact on the borrowing requirement. It does have an impact on where debt eventually peaks. This has been the good news today.
Going into the budget, there's been a lot of focus, and of course a lot of focus here domestically on government's public sector wage bill. Now, the minister, it seemed in the main speech at least, seemed to almost sidestep that. Poor Senzo Mqunu, the Minister of Public Service and Administration, he's been told that he'll get a fair agreement. Did the market need a bit more than that?
Well, markets went into this budget thinking the government had a court ruling go in its favor in December. Yes, there's still a little bit of uncertainty regarding how much of a wage increase the government might have to give over the course of the current fiscal year. But it's probably negotiating from a stronger position. So yes, there is this element of uncertainty. We know no more about future wage negotiations. We don't know for sure that this is going to go the way that markets would like to see, which is an outcome that allows the Treasury to say, we have altered the composition of spending in a pretty meaningful way. All along, we were focused on consumption. Now we're creating the room for greater investment. It's important because nothing else creates the expectation that the South African economy will see different growth in the future. But on the point about how much we know now, you're absolutely right. We're still relying on the same assumptions. And the hope is that we will see a favorable outcome in terms of the next round of wage negotiations, but it's still uncertain.
I'm sure there'll be unionists queuing up to give me the other side in a moment, Razia. I do need to say, I mean, you've been following our economy for a very long time. You'll know how many problems we have. Firstly, with frankly agreeing on an economic plan, and then secondly, implementing the thing. Now there's going to be a focus on infrastructure. Now, we need the focus on infrastructure. You drive around the country, we see it everywhere. There are huge problems. But implementing infrastructure renewal is hard. It's costly. There's scope for, I'll be polite, patronage. It comes down to a question of whether or not investors can actually believe that we'll do it.
And this is where implementation is going to be all important. This is the opportunity for South Africa to turn around its recent reputation, its recently acquired reputation, if you like, of perhaps over-promising and under-delivering. No one doubts that a focus on investment is needed. If you want to boost growth in the South African economy, you do fundamentally realign spending, even if there's some opposition to the idea that that is being done, but also the issue of how this infrastructure rollout is going to be taking place, the importance of public-private partnerships that were emphasized so much in the budget speech. Implementation is going to be key, and there needs to be a recognition that the recent track record on delivery in this respect is probably not the best, not the most positive, and therefore near-term wins will be all important in creating the confidence that is so needed.
Razia Khan, thanks very much indeed. Really do appreciate the time. I know you're very busy today. Managing Director, Chief Economist for Africa and the Middle East Global Research at Standard Chartered Bank. All right, with me in our studio, Kopano Gumbi, Ayabonga Cawe as well. Ayabonga, I should have done this a lot earlier. You're disappointed there's no wealth tax?
Well, yes, partly. And I think a lot of that has to do with a comment I was making earlier on, that this is probably not the kind of time you want to be increasing your taxes on consumption and income. So your excise duties, well, in some cases you have to, and your VAT and your personal income tax and your corporate income tax. But surely there should be scope in as unequal a society as we have to start to think about taxes on wealth as part of a coordinated response and as part of the storyline around this debt management strategy. I mean, we're not going to get to some of the ambitious targets that the finance minister is setting without crowding out growth if we don't start to think about some of the things we should be doing on the revenue side of things. And I think, this was a perfect opportunity to start on that phase it in, or even just to, I guess, signal that this might be something that is in the offing.
Kopano Gumbi, I mean, the arguments for a wealth tax, and there are plenty of them: social solidarity, the highest inequality, as Ayabonga's mentioned, pandemic, people living on social grants, all of this. I mean, the arguments are very strong. The arguments against, I imagine, for Treasury would be they're possibly worried about immigration, a conversation some people talk about and some people don't, possibly worried about confidence, which was, interestingly for me, the first thing our guest from business pointed out about confidence. It's actually quite a difficult decision for the Treasury to make. Politically, it's easier than it is financially.
Absolutely. And I mean, we did an interview with a research hub at WITS who say that in reality there's no evidence to support this idea that there would be capital flight if we introduced a wealth tax. And so we're not really sure that that would cause any of the cons, but we are very sure of the pros. So it really, I think it boils down to will, political will, to introduce an idea like this at a time that we really need it in South Africa.
Kopano Gumbi, Ayabonga Cawe, thanks very much indeed.